It seems that we're now over the bad news coming from Libya, the bad news coming from Japan. Are we going to see a nice tick upwards, or are they still very much risk averse?
I think those issues are still in play. The situation in the Middle East is far from resolved, so I don't think that part is over. However, our base case is that the situations in both Japan and the Middle East are not going to derail the global recovery or the markets for that matter.
So talk me through your ideal portfolio. I was going through your notes and your research notes, and you're, for example, saying that you favor developed equity markets over developing. So emerging markets don't look so attractive anymore.
Well, what's happened is that longer term, they do. And we think that emerging market equities will outperform developed market equities over the next 5-10 years. However, we're at a point in the business cycle right now where the emerging markets, which led the world into recovery, are much farther advanced, and therefore positive growth now in emerging markets elicits inflation pressures and monetary tightening, and that's an environment that makes it much more difficult for markets to move up. And you've got to be a lot more discriminating and worry about things like timing. Whereas in the developed markets, there's still economic slack. And particularly in the United States, there's no prospect for policy tightening, at least on the monetary side, anytime soon. And so you can get that strong economic data and not have to worry about the Fed choking it off. And so we like equity markets there a lot better.
Larry, you prefer the U.S. markets, but you still say that European valuations remain pretty attractive. Are you not worried that if we raise interest rates too soon, that's going to choke off any kind of recovery? Plus, we have this European debt crisis back at the forefront.
Right. I mean, I think those are still concerns. The European debt crisis is not over, as we just saw with the downgrades. It's still ongoing. We've argued all along this is a marathon, not a sprint. However, if you look at European stocks, valuations are attractive. Growth, at least in the northern countries, is pretty solid. So we still think there's some upside room there. But it's not without its risks, as you point out. I mean, we do think within the next few months, the European policymakers will be able to put in a framework that'll give investors some reassurance that the problems will not extend to Spain. In other words, that Spain will not need a bailout, and that's quite important because Spain, as you know, is a much bigger country than the countries that have had
once it hits Spain, we're
far.
in real trouble. Larry, I was going through your asset allocation. Is there anything that actually you think investors would find surprising? You say you, for example, recommend long duration on the front end of the curve for bonds in the U.S. What about the foreign exchange markets?
Yeah, I just say that in general, we like equities over bonds. And this is not just a short-term outlook for the next few weeks, but really an outlook over the next few months. You know, if you look at the big data surprises over the last few months, it's been in inflation, not growth. And inflation's been higher than policymakers expected and that markets, and it's just about everywhere, and it's not just food and energy. When you combine that with policy settings that are very low everywhere, in other words, interest policy rates are very low. There's only one direction for them to go, and that's up. So over the longer term, we don't think you're going to make much money being in fixed income markets. As far as the currency is concerned, you know, the U.S. longer term does have some issues. They're going to have to tighten both monetary and fiscal policy, get huge budget deficits, real interest rates deeply in negative territory. That doesn't bode well for the dollar longer term. But now's probably not the time with the resurfacing of European debt problems and growth prospects look better in the near term in the U.S. than elsewhere. So this is probably, if anything, there's a little upside risk on the dollar near term.
Larry, what about the commodities? We've seen quite a lot of volatility on the price of oil, but on the longer term, I imagine this is still a safe bet.
Yeah, we still see some more upside for oil. As I said before, the situation in the Middle East is far from resolved. Among other commodities, one area that's been softish lately in the base metals is copper. And when we look at the supply-demand fundamentals, we see a lot of upside for copper. So we think there's a pretty good entry point to buy copper. Oil, very tough because there's obviously a risk premium in current oil prices that covers in case things get a lot worse. And if the situation calms down in the Middle East, you like to see oil prices actually come off. Our best guess is that oil prices continue to rise through the second quarter, say another 5–10%, and then taper off. And for the average for 2011 as a whole, we're probably is not going to be far from where we are right now.
All right, Larry, thank you so much. Larry Kantor there from Bar Cap.